Hello again and welcome to the International Tax News video January 2019 by Benefitax, German Chartered Accountants in Frankfurt, Germany. I hope you had a good start into the new year and I wish you all the best for 2019. This edition covers the following topics. First, we will make traders selling in Germany via internet platforms aware of possible VAT problems. Then we will have interviews with tax experts from China and Hungary. And last but not least, we wish to raise your attention to what may happen tax-wise if managing directors of foreign corporations take a German residence. I hope you will like it.
Sales tax changes for foreign traders selling in Germany via internet platforms. First
of all, I'd like to give you a little background. Many companies located abroad sell their products and services to private individuals in Germany via internet platforms, such as eBay, Amazon or Alibaba. In this case, the foreign company owes the sales tax in Germany, which is called VAT, Value Added Tax. If they don't have a subsidiary or permanent establishment in Germany and are also not registered for VAT purposes in Germany, they don't pay the VAT. This applies mainly to Chinese companies. So far, only approximately 1,000 foreign companies have registered for VAT purposes in Germany. But it can be expected that it will soon be 1 million if the following new VAT rules will be implemented. Operators of internet marketplaces will be obliged to provide the following information of companies whose turnover in Germany is subject to VAT to the German tax authorities. If they don't follow the new rules, fines can be imposed, and the operator of the internet marketplace himself will be liable for the VAT of the foreign seller. This can be avoided if he can show a valid German tax registration of the seller. Therefore, it can be assumed that all operators of internet marketplaces will insist on that certificate. The application of the new rules is from 1st of March 2019 for companies with legal seat outside the European Union or European Economic Area, and from 1st October 2019 for companies with legal seat in the European Union. For foreign sellers, that means that if they don't want to disappear from the German market, they should get a German tax registration soon, appoint an authorized recipient for communication with the tax authorities, such as a German chartered accountant, file regular VAT declarations and pay VAT in time, and include the new tax in their pricing. And now we switch over to our interview partners, Tony Shao from China and Dr. Attila Kovács from Hungary. I'd like to introduce to you Tony Shao from Beijing in China. Are there any tax changes in China which would affect the German investor?
Okay, there's two trends. One is that, globally we have a tax cut. And also in China, we also have a tax cut. Let's say the VAT, with the standard, the VAT rate is normally the 17%, but right now 16%. Okay. And for other the categories of VAT from 6% to 5%. From 11% to 10%. So it's a trend to have the tax cut in China right now. The second issue is that for the SME, small and medium-sized companies, if you are the annual revenue is less than normally it's less than 5 million RMB, you have preferential policies to have, let's say, for the corporate rate, for corporate income tax rate, the standard is 25%. Okay. But if you have a small and medium-sized company, you can enjoy a half percent of that. 0.5%? Yes, wow. 50% deduction. Okay. And right now, we increase that criteria from 5 million RMB annual revenue to 8 million.
Wow, that sounds interesting.
And also, if you are the high-tech, you can also enjoy very good preferential policies.
Okay, thank you.
Yes.
My next question to you is if your clients, Chinese clients, think about Europe as a place to invest, is then Germany a good location for them?
Yes, so for the Chinese ODI, the overseas direct investment overseas, we used to have the practice from mainland China to Hong Kong and then to elsewhere. That's the 70% of the ODI. Mm-hmm. But right now, because Germany and China, we signed the double tax treaty. Mm-hmm. Germany is definitely a popular place for Chinese investors.
I see. Okay. Oh, thank you very much, Tony. I'm here with my friend Dr. Attila Kovács, who I welcome very much in our video. And I have a couple of questions to Attila. What makes your country, Hungary, interesting for German investors? What is the USP?
Hello to Germany. My name is Attila Kovács. I'm from Hungary, Budapest, and I think my country, Hungary, is quite interesting place for investment for German investors because we have quite low corporate tax rate. We have reasonable rates of social contributions, and I also think that we have lots of educated workforce there. So overall, I think the Hungarian legal system is quite stable, which every investor may rely on.
So, last question, what would make Germany more attractive as a place to invest in?
So I think less bureaucracy and a little bit lower tax rates could make Germany even more competitive.
Thank you very much, Attila, for this interview.
Thank you so
much.
All
the best.
Thank you.
Tax consequences of the place where the management lives.
In many countries, a corporation is taxed where the legal seat is located. It is often underestimated that the place of management is decisive for tax planning in Germany. I will show you two examples. Section 1 of the German Corporate Tax Act reads: corporations, associations of persons and assets which have their place of management or their registered office in Germany are subject to unlimited corporation tax. Please note that besides the legal seat, the place of management will be sufficient to create an unlimited tax liability in Germany. The place of management is where the management usually makes its decisions. Example 1. The sole owner and managing director of an Indian Limited with German subsidiary moves to Germany with his family and manages both companies from Germany. Result: all profits of the German and Indian company will be subject to unlimited taxation in Germany and must be declared. However, when it comes to taxation of these profits, the double taxation treaty between India and Germany provides exemptions for the Indian permanent establishment. Example 2. Can a private apartment of a managing director in Germany create a permanent establishment? Result: Section 12 of the German General Tax Code reads that a permanent establishment can be assumed if the place of the management is in Germany. If the management of a foreign corporation is frequently in Germany, that is more than 183 days, and carries out management duties on behalf of the corporation, a fixed place of business can also be assumed. This can also apply to a private apartment if this is available on a regular basis for such activities. In case of several managing directors, an individual weighting must be carried out. The relevant criteria is how many days the managing directors stay physically in which country. Communicating via email or Skype from abroad does not count here. And again, we have come to an end. I hope you liked the topics and got some useful information. Next month we are going to talk about the tax treatment of US LLCs and S-Corps in Germany, and there will be 2 interviews again. Please note that I will be in Israel next month visiting clients and attending a tax conference. If you are located there, need tax advice from Germany, or want to set up a subsidiary in Germany and want to meet with me in Tel Aviv, please let me know. Take care and see you next time. Your Oliver Biernat.